Welcome to Buy, Hold, Sell. My name is Matthew Kidman, and the stock market is down almost 5% since the start of May. Just in the last week, we've had a fund manager, a notable one, say it's time to sell everything, and he gave all his money back to his investors. Next thing we know, Morgan Stanley comes out and says Australia's decoupling from the rest of the world and our market's overvalued. Great thematic to talk about. To join me is Mark Whittaker, Investors Mutual, and Joe Magyer from Lakehouse Capital. Welcome, gentlemen. Joe, I'll start with you. Is the market that overpriced, and should we be that worried?
I think it's a little severe. I mean, there's always opportunity in every market. And the thing is, I think a lot of investors who are worried about Australia, the economy, you're not obliged to invest in Australian-only equities. There are plenty of companies here that have diverse global footprints, recurring revenue streams, and that are plenty attractive.
So plenty of opportunities. Mark, Investors Mutual, are they going to give all their money back, or is there a viable business model to invest in the share market in Australia?
I don't think we've quite reached that point, Matthew, but obviously there's opportunities in the market. I think irrespective of whether you think the market's full or fairly valued or cheap, there's always opportunities. So that's what we do as stock pickers, that we look for those opportunities.
Okay, let's go down the bad scenario. Let's say things are overvalued. We are in for a correction in the near term. How do we get ready for that if you're a long-only investor?
Well, we've got a mantra of investing in quality companies at reasonable prices. So our view is if you're holding enough quality companies in your portfolio, you're likely to outperform in down conditions more so than if you're holding more speculative or perhaps stocks that are more orientated towards the growth side of the market. So we're happy with those
quality
sorts
is
of
a
companies.
subjective word.
It is.
And so what is your version of quality?
Well, we're looking for companies with recurring revenue, as Joe alludes to. So there's quite a few companies out there with, earnings growth in their own control. So they're not relying on the cycle, they're not relying on the wider market. There's actually initiatives under their own steam that they can execute upon and derive growth that way. And we're looking for companies with some sort of competitive advantage, so whether it's pricing power, some sort of network effect, something that gives them the ability to execute better than their competitors.
Okay, Joe, another way of doing this is reallocating your money to other assets. You can go to cash, you can go to fixed interest. Is that the time, or is it better to get into the stocks that Mark's talking about, those dependable, self-reliant companies?
I mean, I think it's a good time to have a little bit of cash. I always think it's good to have some cash. I think it's psychologically positive just to know it's there. I think, though, the quality does tend to treat you well across cycles. I think now is a good time to own it. No one is holding a gun to your head and saying you need to own banks or miners or retailers, and you can still own quality businesses with recurring revenue streams at any time.
But you take those indexes out and you shrink the Australian market dramatically.
Well,
miners and banks
our fund
and retailers, what else can we invest in?
Well, our benchmark is the small awards, and it's about 6% IT. We have about 70% of our capital in IT.
Right, so you think that's fairly resilient?
I think that a lot of IT companies are, but not all of them.
Okay, Mark. One thing I've noticed is that every fund manager has got cash at the moment, more cash than ever. That doesn't tell me it's near the top of the market. Do you agree with that assessment?
Look, we're sort of weighted to cash more so than we would previously. As Joe says, it's always good to have a little bit of cash. It's always a rainy day, weather's a bit soggy, you want a little bit of cash.
Well, we've got 5 rainy days in
We
Sydney,
do. Sometimes
that's a bear market in my eyes.
That's right. Well, sometimes you want cash because when it's time to go shopping, you want to be able to be flexible and nimble and move and so. I mean, valuations aren't exactly compelling across the market. I mean, there's pockets that we see that are value. But it doesn't hurt to trim some of your core holdings when they tend to run a little bit, and as things get a little bit full, it's good to just trim and build that cash levels a little bit. And it gives you the opportunity to sort of wade back into the market when valuations become a little bit more compelling.
Okay, let's stick with your valuation. 10-year bonds in Australia, 2.3, 2.4%, lower in the US. Yep. PE of the overall market, 17, 18 times, a bit higher for industrials. Is that a good equation, or is that expensive?
Look, it's full. It's full, and obviously your bond proxies have had a good run. There's no doubt about that. But you can still get good yields of 6-7% on some stocks. Some of those are fully franked. That's pretty attractive, and we'd like to think those sort of levels of yield are quite supportive of share prices. As I say, not every stock's going to be as robust, but we think there's some good names out there with good yield that can hold their levels at these prices.
Okay, Joe, we're worried about housing in Australia. We're worried about bubbles elsewhere in the world. You mentioned technology. Let's go through a housing collapse. So, it affects banks, it affects markets. Mm-hmm. Does technology just keep powering along?
It can, but it depends on what you're looking at. I mean, 21 of the 24 companies we own have some sort of defined recurring revenue stream, whether it's a subscription or a long-term license or agreement. That gives us a lot of visibility. Most of them also have operations that, if they're not dominantly overseas, are pretty diverse. So it takes you a pretty long way in terms of making sure that your downside's protected.
Okay, scenario. We wake up tomorrow morning, the US market's down 25%, it's 1987. what do we do with that cash we talked about?
I'd be pretty keen to go out and buy more of what we own, probably faster growing companies.
Mark, as you know, people will be taking their money out when that happens.
That's
Everyone
right.
runs to the hills. What do you do if that D-Day happens?
Well, look, I think we've got some nice quality names that we own, which we think are pretty much core holdings of the portfolio, so we'd certainly be topping up on some of those. And there's plenty of good quality stocks out there which are just expensive at the moment. If they got attractive, well, I think that's the time to go shopping, as I said. So we'd be certainly keen to add some of those names.
Well, it might be running in Sydney, but there's still plenty of gardening to be done on the Australian share market.